The Fed, as expected, leaving rates unchanged, but indicating it sees 2 rate hikes this year rather than the previously expected 4. Here with more, Max Wolff, he is Chief Economist at Manhattan Venture Partners. Great to have you here.
Great to be here. Thanks for having me.
All right, so how significant is that indication that we're going to see basically half as many rate hikes as we expected back in, say, December?
So it's sort of a Goldilocks report if you don't look too deep, and so far the market hasn't. And that is, look, things are just bad enough that we're not going to make it any more expensive for you to go into debt, and just good enough that we're still positive about the future. That's kind of the Goldilocks, not too hot, not too cold. On the other hand, I think what we're seeing is this is a patient, the economy, that still can't get off the ventilator, and we're no rush to take this patient off the ventilator with the usual verbiage that the patient is super healthy, and that's why they're enjoying a wonderful outdoorsy lifestyle attached to the ventilator.
Right, and the Fed always likes to remind us that they are data dependent.
Yep, and look, the data's been a little bit harder to make sense of than I think that the initial comments suggest. So we keep hearing about inflation. Inflation is actually negative, which is not a good sign. It's a bad macro print. Core inflation is positive, and we've just decided to exclude food and energy. Never really a great idea. Started in the Nixon administration, which not everyone associates with the whole truth, nothing but the truth, and the truth, and maybe not a great habit to be in. And also, last time I checked, there's some interesting things going on with food and energy. Perhaps others have heard of it too, so it might be a particularly inopportune time to do something that's marginally defensible on the best of days, which is talk only core.
It sounds like you're skeptical about whether they're on the right track.
Look, I don't think the Fed has a lot of options here, so I'm not a big Fed basher. I think the world's full of what I call Fedophobes and Fedophiles. So there's people who believe the Fed can magically touch anything and make it right, or everything that goes wrong is secretly the Fed, right? I ascribe to neither of those rather crazed belief systems, but I do think the following. Asking the Federal Reserve to make monetary and fiscal policy because Washington, D.C. doesn't function and we don't pass laws, and also somehow repeal the business cycle is a lot to put at their plate. They do try pretty well, but the problem is they've tried too hard too long, they don't have a lot of dry powder, and we've gotten very addicted to this particular economic ventilator instead of going through the cycle, which, painful though it is, we probably need to do.
And speaking of Washington, politics are heating up. That's kind of the understatement of the day. As we get more and more into the election season, how much political risk is there? Because a lot of congressional Republicans really want to put a leash on the Fed, really want a little more control.
Well, I mean, I think one thing that's sort of interesting in the broader picture is the market is seriously pricing about a 0 probability of a Trump victory. We know that because you'd see some kind of reset. Both Trump and Cruz, the presumptive sort of folks with delegates left on the Republican side here, so one of them is likely to get there, although, you know, it's still too early to tell, and it could be Kasich or someone else. That notwithstanding, they both said things about the Fed, they both said things about international policy and domestic economic policy, particularly Donald Trump, that would make the markets react quite violently in a negative direction were we handicapping their victory, which it looks very, very, very clear that we're not. The other thing people should keep in mind is election years mean instability, they mean high passions in weird areas for markets, and less visibility, none of which is constructive.
For now, though, the markets did seem to like this.
Absolutely. Look, more cheap money and a good outlook on the economy is the best of both worlds. Again, sort of Goldilocks. And the idea here is the economy is growing pretty well, labor market strengthening, some positive price signal. I guess they mean core or PCE. And so generally pretty good on that front, which I would agree with. Pretty good, but the United States remains good in the sense of being the cleanest dirty shirt in a global hamper with some real stinkers in it.
So bottom line, where do we go from here?
I think where we go from here is sideways with a slightly lower trajectory. I think a lot went right toward the second half of the first quarter, which is good. My guess is that we don't stay on as bullish a trajectory as we've been on for the last 5 or 6 weeks, but I don't see us retesting all the lows right away.
All right, we'll leave it there. Thank you so much.
Thank you.